Thank you for the introduction, Steve and Irina. And thank you to Alan, Paul, Scott, and Simon for joining me on our panel today. Let's jump right into our first question. Many investors are placing an increasing priority on environmental, social, and governance considerations. To what extent are ESG considerations becoming part of the manager research, due diligence, and selection process? Scott, I'll turn it over to you first.
We're really seeing ESG get incorporated in the hedge fund community in two ways. The first is more defensive from a risk identification perspective. And the second is a more offensive implementation, which is constructing portfolios which are specifically designed to have an impact orientation. On the defensive side, this is really fundamental credit and equity managers considering the earnings or balance sheet implications that a environmental or social event could have. And of course, governance has always been a consideration, especially around minority rights, and hedge funds have often been vocal advocates in enforcing those rights. We also see governance signals show up in quant equity manager programs as one of their signals. So I think there's a pretty long history of considering those as part of the investment process, but again, more related to identification of risk. And I think the more recent shift is in response to the demand from allocators to have investment portfolios that are oriented not just towards risk and return, but adding this third dimension of impact, which is pretty fundamental if we think about the shift that implies towards the optimization and portfolio construction process. And as a result, we've seen both on the long only side as well as the hedge fund side, quite a few new products being launched. And at least from our seat, a pretty big dispersion in terms of the quality of those. Some really do represent a fundamental reorientation of the portfolio construction process and a real impact delivery. And I think others probably deserve the label of greenwashing.
Thank you, Scott. Paul, can you share your perspective on how ESG priorities are impacting fund managers and their processes?
We are seeing regularly now, and this change has really just happened over the past 2 years, that basically not everybody, but majority of people who are doing due diligence on Glazer Capital are now looking at our ESG policies. I am not yet at the point where I think that it actually impacts to a large degree their allocation decisions. I think that it's more at this point, it is quickly evolving, as we all know. And at this point, it's more of a kind of a check the box. Do you have an ESG policy? Please send us your ESG policy. So we do think it's important. It is something that personally I, want to see promoted. It's hard to be against any of these policies, and it has to carry over into the investment side of what we're doing. I found that the best description of why it's important to have an ESG policy came from one of our family office investors. They said, gee, I speaking to the investment people at this family office, they said the family has a lot of money. They're very philanthropic and they're giving money away for ESG causes. Why would they invest in companies that are going counter to what their philanthropic goals are going toward? So that made a lot of sense to me.
Simon, from your vantage point, what trends are you seeing when it comes to family offices and institutional investors you work with in this area?
I think so. ESG has certainly come on in, I would say, the last 5 years, especially even the last 2 years. It seems like there's been a cataclysmic shift in how much people care about ESG or ask questions, or and it comes from our institutions asking us, and then we obviously have to have a policy of our own, and also look towards where they're investing and what the policies are there. I think there's a lot. One of the issues with ESG is it can really encompass quite a lot. And I think a lot of people look at it and they expect different answers or want different things from their policies. Really, I think when it comes down to it, there's two major issues I think that people are concerned about these days that we work with managers to try and kind of quantify if possible. One is And this is more centric to the US, a little bit in Europe, outside of Europe and the US, really not that important, but diversity. So diversity of staff, diversity of the management team, that kind of thing. So we do get a lot of questions on that. We do collect the data on that, from our managers to try and kind of at least get the information to our investors. As I think Paul mentioned, it's not quite clear if people are actually making decisions based on this, but I think they're still in the process of kind of collecting this data. The second is a lot more difficult, especially in the hedge fund space, is really carbon footprint. So what is the carbon footprint of the actual firm itself? And then what about its investments? How do you measure carbon footprint? That is a little more challenging. It's easier when you get into kind of or slightly easier when you get into private equity kind of in a portfolio, but in hedge funds, it can be extremely challenging to gather that information. And I think the information, even when people do provide it, is provided in different kind of formats. So it is challenging, but I think that's where the industry is going, is really these two kind of fundamental pillars are what people are really looking towards measuring in their portfolios. And we're getting there. It's just taking a while to get there.
It's a great perspective. Thank you, Simon. Alan, I'm going to let you chime in here. What kind of significance are you seeing placed on ESG considerations in your work with family offices?
Oh, thanks. First of all, I'll just say, if you met one family office, you've met just one family office. It's probably over repeated, but it makes the point is that some families, this is a critical area of concern. I remember counseling a Gen 3 member who wanted to give all her money away and was like horrified when she found out that she had, hundreds of millions of dollars net worth. And yet others, this is not a priority. I am a little jaded. We ran a couple $100 million for the Sierra Club for 6 years. And I walked away really wondering, a lot about what I've already heard. What is true impact? What is greenwashing? And how are you actually going to change things? And I think that, frankly, I'd been asked by a nonprofit to help in 2017. We worked together with a couple of family foundations and organized an effort. I encouraged them to focus on basically a hedge fund strategy, an activist strategy, rather than their normal 60s activist work. And we targeted a company named Exxon. I think some of you may be familiar. We ended up getting 6 environmentally minded folks on the board of Exxon in the last year. Just keep in mind, I don't believe one ESG fund participated in what was probably the largest environmental coup. And so, at least not on the mutual fund side, perhaps on the hedge fund side. So I think that, in looking at it, and I guess one did, a couple, you got D.E. Shaw and Engine One, both were, leaders in that space. But, to that same point, environmental, social governance, what they left on the table was governance, and ignored a shareholder move to independent chair. So it ESG is very much in the eye of the beholder, and I think that one of the challenges is that very few people share those same similar values on all fronts. So I think going back to the greenwashing comment, I would just say that one has to be careful that they're not getting a teddy bear and just feeling good about something and actually having true impact. So you see that in private equity. In the private venture space, it's much easier to have impact. Otherwise, if you're not a shareholder, you don't have a vote, and it's very hard to have an impact there too. So I think that there's a lot of room for improvement, and I think that different families are approaching this in a different way. But a friend of mine's family foundation just hired a consultant. I think they're just announcing it yesterday or today. But the focus at $500 million New York Foundation focus on purpose and not on returns. So certainly there's a change afoot.
Thank you all. It seems safe to say that the importance of ESG considerations is unlikely to wane anytime soon, but it is a complex and evolving area. And navigating the space, leading in this area, may provide opportunities for real impact. Let's move on to our next question. Scott, based on what you're seeing in the marketplace, what types of strategies do you see the industry moving toward?
I think one of the biggest trends is around private investment by hedge funds that historically have just looked at public equities. And you're seeing the convergence between the PE side in the sense that earlier investments in pre-IPO candidates uh, ahead of some sort of liquidity event. And I think obviously this isn't brand new. We saw hedge funds dip their toe in a reasonably big way into illiquid assets prior to 2008, and then saw a big pullback from that. So I think to some extent there's some cyclicality to this. The other thing, which is a little bit more micro, is we're seeing more opportunities to participate in the equity market, equity capital markets calendar. So IPOs, blocks, secondaries on a dedicated basis. Again, this isn't new. This has been a strategy that's been bundled up in multi-strats and a profitable one at that. But over the last couple of years, we've seen a much greater ability to invest in that on a standalone basis, and I think is really taking advantage of the robust environment in the capital markets. The last comment I'd make is not a strategy particularly, but a region, and it's Asia. And while there was a brief pause after March of 2020 in terms of interest in Asia, we see really broad and widespread action in terms of trying to diligence managers in the region and identify ways to participate. Um, as the long only side is starting to build up in that area, I think the allocators are looking to see how they should be approaching the region from an absolute return perspective, and you're seeing quite a bit of research being done there, certainly disproportionate to the capital that's allocated.
Very interesting. Thank you, Scott. Paul, what are your thoughts on the strategies that will be successful moving forward?
We participate in merger arbitrage. We've been doing it for 22 years, and I started in it before that. And at that time, it was an old strategy. It was always a niche, and it's kind of a staple. It's not ever the flavor du jour. What has crept into the strategy, broadly speaking, is SPAC investing. We've been investing in SPAC since 2009. And when we started back then, because during the great financial crisis, SPACs went to discounts to cash and trust. So we said, gee, this is easy. We'll just buy them at discount to cash and trust and wait for them to go up, and which we did. And we've done that every year since then. And it's always been a small part of what we do. And it was never ever something we heard about from brokers or other ARBs. And lo and behold, late 2019 and into 2020, it became a hot area. I think due to COVID, people were at home, they were bored, and they just started buying SPACs anytime they announced a deal. And it was good for us. We were up 33%, 37% in 2020, which is far beyond anything we ever had before. That seems to be over right now. But what has remained from that is that there are now 400 SPACs outstanding, as opposed to maybe 40 or 50 before this all started in late 2019. And SPACs have become legitimate. It used to be that only marginal companies that could not do traditional IPOs, would find another way to go public, and they would do it through a SPAC. SPACs, because they don't have all of the reporting limitations that an IPO has and can put out projections, have become a very important way for companies to go public. So I think that's going to be with us. That's a permanent change, and that's going to be with us going forward as a place to invest. It's not particularly relevant to us. We only invest more from an arbitrage point of view, that we have started, to Scott's point, two other funds that invest in the illiquid part of SPAC capital structures. We're investing in the risk capital and in pipes and we found a pretty interested audience and raised decent amount of money in that area over the past year. And I think that that's going to be a continuing that also is going to continue, and that also is quickly evolving as valuations get worked out for what are oftentimes non-profitable companies and sometimes late venture type of companies that are now in the public marketplace that never had been previously. So that will be good for our non-public illiquid funds that we raise, which is a small part of Glazer Capital in general, and won't really have a big impact or any impact on the big funds that we do manage. But I do see that continuing. People do have an appetite for the privates. That's what I see. Thanks, Katie.
Thank you, Paul, and thanks for your thoughts on where we are in the SPAC cycle in particular. Alan, what asset classes or strategies do you see on the upswing?
Well, first of all, I did want to just mention that I'm a big believer in the liquidity features on mutual funds, and I think that's will continue to be a challenge. In '08, family I was working with had a lot of challenges with liquidity, and so having liquidity, is a big is really the one factor that allows for low correlation to be a benefit. That said, speaking of low correlation, things like crypto, I think that we're going to continue to see growth in that area, more sophistication, not too different than what we've already seen in cannabis as that continues to grow in the space. Families continue to be very focused on fees, and they hate paying fees. I mean, that's what I'm I kind of am tired of. It's like, don't you care about the ultimate return? But people care about fees, and they want to feel like they're getting something for their fees. So typically families are much more interested in co-investment opportunities where they feel like they can add some value. And then there's a lot of families that are working together, especially here on the West Coast, where they believe that they bring the alpha themselves and that Wall Street doesn't have any alpha to offer. And so, they can be quite outspoken about that. But I think you see that with many of the first gen entrepreneurs where they are teaming together to make direct investments themselves. That said, the comment I hear from them regularly is that we're really good at alpha, but the challenge is we don't know how to manage our cash. And so strategies like Paul was talking about, where there's deep understanding of different strategies that in analyzing the market, I think that there's a big interest, will always be a continued interest there. And as short-term interest rates are zero, people will continue to look for how do we manage our safe money, how do we get some return versus what we get at the bank.
Thank you, Alan. Now I'd like to pivot to the operational side of things. So working from home has reshaped how businesses conducted their operations during the last year and a half, and we know hedge fund operations did not escape this disruption. How do you think what we've learned in the last year and a half has shaped the future of hedge funds with regards to core processes and the working environment? Let's start with you, Simon.
Yeah, I would say disruption could be called transformation here because it has really transformed quite a lot of how we're seeing people operate. I think, the most obvious is a good example here, right? We're not all in person. We're actually Zooming or over a virtual network, right? That seems to be transitional in that I think a lot of people never thought that this would exist and never thought that it could work in the past. And people have really come to believe that, we can work over kind of remotely. It's not optimal. I will say, my personal feeling on this is the longer we're going into this cycle, the harder and harder it is to actually build a culture and get, and train analysts and get them up to enjoying working at some place, not just for the salary. I think that's always a challenge. I mean, they have called this there is a lot of turnover, as everybody knows, the great resignation, as they call it. But, I think part of that is going to continue as long as as long as most people are virtual. I think it also transitioned a lot more, went to the cloud. That was happening anyway, but I think a lot more of our kind of the funds that we look at actually, or the managers we look at actually went to the cloud. One kind of legacy thing that's definitely going away is the use of kind of an offsite for, if your office was unavailable, everyone would, meet up in, Stamford, Connecticut for, in 50 desks up there that I keep as a hot site. That I think has been uh, that is quickly going away, if not put to grave. I think people realize it's much easier for people to work in their office or from home than they thought was possible. So I think all of that has really changed, from where it was. I do think going forward, most people are going back to an office environment. I know we've got, a selection of people in already, and that's growing pretty much every week. And hopefully we'll be back. But I do think people will be given more flexibility, and I think there's two parts to that. I think one is people have realized it works, and secondly, I think the employees are kind of in some, especially some sectors, are kind of using that and looking at two different employment opportunities and saying, if I can work 2 days from home in this, it's actually more attractive to me. So I do believe that we are going to go to some kind of a hybrid model, most likely for the going forward.
Thank you, Simon. I really like your comment. Disruption can be viewed as transformation. Alan, what changes do you expect the industry to adopt going forward when it comes to how work is conducted? And are there norms you think the industry is eager to return to?
Interesting. I think from a family office perspective, the big challenge really is going to be back to the same thing about family offices. Each of them is different. I think that generally people are going to be much more willing to accept remote work. But I think that family offices, by I think their nature, are very demanding. And I would make sure I would encourage people to make sure they're not overly optimistic about their ability to not travel. We just I do an annual conference in the Hamptons in August. We had 150, basically billionaire families only. We had 150 people show up in between the hurricane cycle. We were all outdoors, and hurricane, no hurricane. These families showed up because they wanted to be in person. They did the same thing last year. Um, there's a big benefit, and people understand the value of in-person meetings. And so, while I think that there'll be far more opportunities to serve clients remotely and by Zoom, there also will be a lack of patience for folks that aren't willing to show up in person for meaningful relationships.
It's a great point. Thank you, Alan. Paul, what ways do you expect the working environment of the past year and a half to affect the future of work in the fund space?
Well, just looking around my office, we had 25 people in here yesterday and 4 today. That sums it up in a nutshell. It's going to be hard to get people back into the office 5 days a week. I don't think that's a realistic anymore going forward. I think the transition that we went through because of this disruption was very successful for everybody. I mean, everybody says the same thing, including us. Gee, I would never have chosen to do that, but now that we've done it, it was a lot easier and a lot more productive than I thought it would be. So I don't see us going back. The longer term repercussions, I think, are going to be serious, and I don't think they're known. I mean, I don't, training people, creating culture, creating personal happiness, and as Simon mentioned, what is there to a job, and now we have a record number of people unemployed and a record number of people looking, a number of jobs going begging. Standards have changed, and I think that they will continue to change in ways that are not going to be easy for us to predict. But I think, I mean, just to bring it down to practicality in the hedge fund land, I think due diligence will be easier. I don't think we're going to see nearly the number of people coming through our office that we have seen in past years. I think people have taken to Zoom, and I think it's actually pretty effective. As far as the personal relationships, I don't. I question how important that is, but then we have an investor base that knows us, and it may be more difficult to acquire new investors in the future because that we are lacking that personal introduction and the personal relationship. But I wonder if that in general will become less important. I don't know if numbers will speak more for themselves.
Thanks, Paul. And while there have been serious disruptions in the past year and a half, the fund space has also been pretty well positioned to adapt and transform. And you've all spoken to this meaningfully. So before we conclude, are there any final thoughts related to the future of the industry that you'd like to share with us? Scott, I'll turn to you first.
One of the biggest challenges facing allocators has to be the view that the returns from traditional equity and credit markets are likely to be a lot lower going forward than they have been over the last decade or so. And I think the challenge for the hedge fund absolute return community is to identify what role we can play in trying to help solve the portfolio conundrum that conclusion creates. And I think in a way it could be the biggest opportunity since going back 2 decades, you saw institutional capital begin to flow in to hedge funds. And you can think of two examples. For example, imagine a low beta liquid portfolio of hedge funds serving as a partial substitute for a fixed income portfolio, or maybe a slightly higher beta, maybe a bit less liquid, higher octane portfolio, taking a little bit of capital away from equities. It's not clearly displacing massive percentages of either of those allocations, but I do think there's an opportunity for hedge funds to play a much more meaningful role going forward in terms of helping allocators, be it pension funds, sovereign wealth, family offices, achieve their return goals in the future in a more sustainable, robust way than just a more concentrated allocation to equity risk.
Thank you, Scott. Simon, any final thoughts you'd like to share?
Sure, I'll touch on 2 points actually. The first is kind of going back a few questions ago. Just really, we heard people talk about kind of Scott talked about privates and how a lot of hedge funds are kind of getting into kind of late stage IPO or pre-IPOs. We've also talked about Alan talked a little bit about liquidity. I will say, one of the things that we are very cautious about and tends to go in cycles, unfortunately, is just asset liability mismatch. So just, where you're getting, you think you can get out and you really can't, right? Or when you want to get out, when things have turned bad and you're effectively stuck in a manager for a long time typically in a terrible situation. So I'd just be cautious about paying attention to that. I think is very important. The second is more of an operational issue, which is just cybersecurity. I think it continues to be of utmost importance. We talked about the transformation. Just even signing stuff. Oftentimes it's done electronically now, and things are sent electronically, and just. I think everybody still needs to pay a lot of attention to cybersecurity. It's not just ransomware. It's a lot of different ways it can come back to bite you.
Great thoughts. Thank you, Simon. Alan, you want to close us out?
Well, I can't help but to jump on that lead. Liquidity clearly is going to be an issue. I mean, we've had, markets have been straight up. There's been low volatility for years now. And looking at it, what we know is those things do revert to a mean. And I would just say that, in looking at it, hedge funds have a great opportunity here where I do believe active management is going to start showing its benefits. From a leadership perspective, we've seen it in the ESG space already, as I mentioned, with D.E. Shaw um, and Engine One and others. But I think the 60s activists have finally figured out that Wall Street knows something, and that is how to engage with companies. So I do believe there's a great opportunity for hedge funds to provide more leadership with regard to corporate actions, engagement with companies. It's certainly not something that we see from the large institutional investors. They don't have the expertise. They definitely have an interest, as we've seen sort of this whole CA 100 rise and claims of 20 to 40 trillion dollars being managed with an ESG bent. Hedge funds are truly the leaders with engaging with public companies. So I think that there'll be more and more opportunities utilizing proxy actions.
Thank you all for joining me on our hedge fund panel and sharing your thoughts and insights with us today.